For decades, international trade operated through a single-lane system. If you wanted to move goods across borders, your capital had to pass through the US dollar. It was the mandatory toll booth of the global financial market. Headlines often focus on a sudden, overnight dollar collapse, but that noise obscures the actual shift. For the prepared trader, the danger isn't an explosion. It is the friction of a system that is starting to divide. This area chart tracks the share of global central bank reserves held in US dollars. Institutional demand has reached a multi-decade low, sliding from 70% down to a threshold of 58%. The system is undergoing a slow burn, a gradual bifurcation where the global economy splits into two competing, overlapping financial universes. Traders relying exclusively on traditional, dollar-centric strategies are operating in a market that has been structurally rewired for volatility. This transition creates a liquidity trap. While the dollar is losing its status as a reserve asset, it still powers 80% of trade finance because the Western SWIFT messaging system remains the world's dominant plumbing. But the hardware to bypass that plumbing is now operational. Developed by the Bank for International Settlements, a multi-currency software platform called mBridge has matured into a functional alternative. This flow network shows the mechanics. A Thai exporter and UAE importer settle trades directly using digital currencies, moving capital in minutes without touching a U.S. bank. Removing this intermediary permanently erodes the overnight liquidity demand that historically supported the dollar's value. The BRICS Plus coalition is the primary driver of this architecture, establishing regional liquidity silos that lock trade capital away from the Western financial system. With capital locked inside these silos, traditional liquidity pools become shallower. In this environment, a single institutional trade can trigger a violent, unexpected flash move. For half a century, global energy markets were the bedrock of USD demand. Under the petrodollar system, if a nation wanted to buy oil, they were required to use American currency. That requirement is ending. Saudi Arabia now accepts offshore yuan directly for oil exports to China, allowing energy trade to bypass the dollar entirely. This shift impacts the U.S. Treasury. Historically, oil profits were recycled back into American debt. When that trade settles in yuan, the automatic structural bid for U.S. bonds disappears. This brings the Triffin dilemma back to the forefront. To supply the world with dollars for trade, the U.S. runs massive deficits that are now beginning to undermine institutional trust in the currency's safe haven status. The 2022 freezing of Russian reserves demonstrated that the dollar is a permissioned asset. In response, central banks globally began seeking alternatives that are immune to Western sanctions. Physical gold has emerged globally as the ultimate neutral reserve of choice. It is now being bought for its lack of counterparty risk, causing it to decouple from its traditional inverse relationship with real yields. As oil and gold migrate toward this multipolar system, the historical correlations that intermediary traders once relied on are breaking down. In 2026, success at the terminal requires trading the friction between these two settlement systems. You must be prepared for a market that is permanently divided. You must stop relying solely on the DXY. Instead, monitor the gap between the DXY and the Bloomberg Dollar Spot Index to identify where the dollar is still maintaining its utility in trade settlement. Use the offshore yuan as a primary risk barometer for the Eastern Economic Network. In a bifurcated market, CNH moves offer a clearer signal of global sentiment than traditional major pairs. This split-screen chart illustrates the new proxy trades. Spikes in mBridge volume often lead bullish moves in commodity-linked pairs like the AUD or NZD, which serve as buffers for Eastern demand. In these fragmented liquidity pools, price gaps can occur in seconds. To manage this, traders must reduce their position sizing. The same trade volume used in 2020 now carries a much higher risk of slippage and volatility. The goal for 2026 isn't to wait for a total dollar collapse. It is to adapt your portfolio to profit from the friction of a multipolar world.